I have with me Kunal Rambhia from the streets. Thank you so much, Kunal, for taking the time. And I asked you to share with me a few ground rules that budding traders can follow, and you shared 10 with me. So these are 10 ground rules. We'll go through one by one. The first one that you've mentioned over here is don't consider technicals as a tool for only the short term. How do you explain this?
Perfect. So, first of all, thank you so much, Alex, for having me on the show. It's my pleasure to share my ideas and views with the viewers. And I hope these 10 points which we are going to discuss today will help the budding new traders to uh, shape up their, the journey in the financial market using the technicals. So, as you rightly said, the first point is don't consider this technical tool to be like a short-term trading tool itself. What we have seen off lately on almost all the social media channels is that people consider technicals to be like a tool which can help us to find out the breakouts or breakdowns and initiating a buy with the risk reward ratio of 1 is to 3 or 1 is to 2. It's absolutely fine to use that way, but technicals is just not about that. Technicals actually helps us to understand the positional view on the market also. So it's all up to us, how do we use it? That's an advantage of technicals, that we can use it even for short term or even for intraday. But I think there are multiple aspects to it, and one needs to understand as to how he wishes to approach the market. So look at even the trend of the market and figure out whether we can have a long-term view on the market. I am sharing one of the charts here, which is a ratio chart of ITC and Nifty. Now, this chart is being plotted on your screen from 1995 till 2021, where we were coming across those comedy memes of ITC. This chart was suggesting a very clear buy indication, which came right after 2007, after 13, 14 years. At that time, ITC was trading at around 203 or to 205, and we know rest is the history, and it is outperforming as of now. So yes, we can use this technicals even for long term, and that one needs to always keep in mind.
Fantastic. So, but if when you're starting out, is there something that you would give as advice in terms of what the time frame is? Because I think the second point that you've raised is understanding the trend in a comfortable time frame. Uh, is there a specific type of periodicity that you would look at? Would you look at the monthly charts first and then progressively go lower in terms of the periodicity?
Wonderful. So as you must have seen that a view which is given on Nifty by all technical traders is always different. So if you speak to me, I'll say Nifty is right now buy on dip. You may ask the next technical advisor and he may say that the Nifty is looking sell on rise. Now the reason behind that is everyone is using the different time frames. He may be using the intraday, so for him that makes sense. For me, if I'm using the daily or weekly chart, so for me that would make sense to take this entire asset class as the buy on dip. So one needs to understand which time frame to follow. So for that, a trader needs to define how he wants to trade in market, whether he wants to trade for intraday, he wants to play for 2020, or he wants to go for one day match ODI, or he wants to go for test match. All three possibilities are available in cricket. Same is the case with market. We can have positional trading, short-term trading, and extreme intraday trading also. So if one is approaching the market with positional mindset but trading perspective, he can comfortably look at weekly and the daily charts. If one wants to play on the intraday, then would make sense to look at hourly chart and 15 minutes charts. We have very common saying in technicals, which is trend is my friend. And I'm sharing one of the examples here on the screen, that's of Pidilite Industries. You can see again, I'm mainly a positional trader in market, and this is how I look at the market. You can see the chart which is on your screen, the line chart of Pidilite Industries right from 2009 2010. You can see not even a single tick where it went below the previous swing low. Now that's where we play a positional trade on it. We always look at the Pidilite from long-term perspective, reason being the trend is on, and till the time the trend is on, we are comfortably holding the position. The same approach can be adopted even for 5-minute charts and for 15-minute charts. But just need to keep in mind that if the trend is positive, we hold on to our position. If that particular time frame trend is reversing, from making higher top, higher bottom to lower top, lower bottom, we exit the position.
Okay. Uh, Now, I want to take your cricket analogy a little forward. In cricket, at least, there are people who can play test matches and who are still very good at T20. But here you're saying that you should decide your trading time frame and you should not jump the time frame. Why do you say that?
The reason, the third point itself is the same, that one should not change the time frame, because the problem in cricket mesh and in the market is that in market we lose out our money if our judgment goes wrong. And traders mentality is been the same since 1929 till now. You must, I mean, there are many books which are written by the marquee traders in the market, and they are always saying that you control your emotions and mindset. The biggest problem is that once the trade goes unfavorable, the trader will start looking at the different time frames and he'll try to justify his position. The position which is taken only for intraday should be squared off by intraday end itself. One should not be carrying that position. If you jump onto the time frame, you are stuck. Trading on one time frame is very important for the newcomers. Yes, there are books which are written on seven time frame trading system also. I am following a system where there are three time frames involved, but that's later stage of the career. In the beginning, follow one time frame itself, follow discipline. If your stop loss is getting triggered by any chance on the time frame, you should be exiting. You should not even dare to look at the other time frames once the trade is initiated. You can do all your analysis before the position is taken, but not after the position is taken.
Okay. Um, the fourth point that you have mentioned, I think, is going to be very critical if you're starting out, because I guess it limits the impact of the mistakes that you could make. You said decide the corpus for trading. What, according to you, is the appropriate corpus that someone should start with?
So, Alex, I always keep sharing with my followers also that don't try to overtrade and limit your corpus for trading in the beginning. Reason being, we all are prone to make those mistakes. I mean, I have made those blunders in my life so far. It's been 12 years in market. The beginning journey is almost the similar for all the traders. We tend to overtrade. We tend to remove our money from the investment and put it to trading just to justify the loss making position. We can reduce that by following one discipline, and that is limiting our corpus to trading. I think for the beginners, the percentage should be somewhere between 15 to 20%. And once you feel that you are doing good and slowly want to increase the corpus, then the maximum trading position should be like 25% in trading and 75% in investment. And at any cost, we should not be even looking at investment portfolio when we need money for trading, because then in that case we may end up over trading. And over trading, the problem again is that the traders prefer to take leverage, and in that case, using the corpus of 25%, we may end up taking three times of that position, and to compensate for the loss, we may end up taking money from investment. That should not happen. I think the trading corpus should be confined to 20 to 25% for even the pro guys, but for the beginners, it should be somewhere in the zone of 15% to 20%.
So, but is leverage trading a big no no according to you when you're starting out, Kunal?
Absolutely, Alex. So, leverage trading is no reason being that markets are turning extremely volatile and jittery these days. By any chance, the extra position is created and someone fails to follow the discipline in terms of risk management, then the entire capital may get wiped out. So, unless you make a ledger or say journal where you are writing all the trades of yours and you have those 100 trades on the page where you see that the success ratio is almost like 60-65%, then you can take a chance of increasing the corpus. Again, make the ledger of 100 trades, and once you have the list of 200 trades in front of you, by following the discipline, you may start taking a bit of leverage. But otherwise, leverage is a clear no and a very big no to the newcomers in market.
Now, the fifth point that you've mentioned, um, I'm not so sure about, Kunal. I must admit, because uh, uh, let's talk about it, because you said decide strategy and plan the execution well in advance. Can you always do that? Is the question, because you have uh, things that are happening real time. Wouldn't you have to also stay nimble?
Point taken. So what you're saying is very true, Alex. Sometimes it may so happen that we may have to take the call during market hours also, but those are extreme case scenario. Let's take an example of say being a positional trader in market and trading a stock like say Pidilite Industries. In Pidilite Industries, the trend has been positive. We saw the chart right now, right? If I'm applying the trend line on it on the weekly closing basis, that's on Friday closing when the price reaches near to that low, I will initiate a buy on Monday morning during market hours, right? And my stop loss is gonna be the price closing below trend line. Now I don't have to really look at the price from Monday, Tuesday, Wednesday, Thursday again. On next Friday closing, I'll look at the chart and I'll decide whether my entry was correct. And if it's holding on to those trend lines, I can continue to hold the position. And I'm creating a positional trade based on pre-decided entry level. If you're an intraday trader, then your strategy will change, but otherwise your strategy will not change. So if you're looking at only 5 minute charts and 3 minute charts, and you're taking a call on the market during market itself. So today itself it happened. Markets were extremely high in the morning, coming down now. So we may think of them selling the same and buying again. You may have to take the trade in between during the market hours. But what I mean to say here is that having your strategy in place, decide when will you look at the chart. You may get tempted to buy or sell if there is a spurt in the price on the lower side or on the higher side. One should not be impulsive in taking the trade. One should go very comfortable and slow while taking the position.
In fact, that is your next point. Avoid impulsive trade. Could you give me an example then of an impulsive trade? Because this is going to help people understand what they shouldn't do.
So, just to avoid the impulsive trade, I have made a very simple rule for me, and that is that whichever time frame chart I follow, I prefer to wait for the candle closing. Now, I'm talking about Japanese candlesticks, and all our new traders must be knowing what Japanese candlestick is all about. If the trade is initiated, if I'm following 15 minutes candle, so my time frame is gonna be from 2 o'clock to 2:15. I will wait for 2:15 closing. I will not buy even if there is a big spurt in the price and the candle is going up. I will not buy in anticipation of the candle closing near to high. I will wait for the closing to come. That's the best way by which you can avoid impulsive trading, because extreme volume coming in, price may go higher, but over the next 2-3 minutes, price may soft down and come down below the trend line again. And then the traders will feel that, okay, I'm stuck. I did not follow the discipline. That's impulsive trading. We need to avoid by following a simple rule, and that's let's wait for the candle closing, whichever time frame you follow, whether it's daily, weekly, or say intraday. Wait for the candle closing and then take a judgment on the market.
Okay, fair point. You've mentioned that you need to follow stops, and I think you mentioned this in the first point that you raised as well. But how do you set the stop losses?
Perfect. So, Alex, for the beginners, it's very easy to remember the point which I'm gonna say now, and that's if you are following an uptrend. Okay, so your rule is gonna be staying in the trend till the time the trend is intact, because we have a rule that the trend is my friend. So, if the higher top, higher bottom is continuing, there is no problem. You can hold on to your position. But the time you come across a situation where there is a lower top, lower bottom, you exit at that point in time, or you take the support of your trend lines. Now I'm sharing one of the classic examples of 2018, that's of PC Jewelers, right? This counter rallied from almost 30-40 rupees and went up to crazy 500 levels. We saw a vertical decline of 35-40% during 2018 during the after budget session. Price significantly came down. Did not give the chance to exit to those pro traders also. If I follow pattern, yes, there was an exit near to 300 levels also, but just putting a simple trend line on the chart, which is on the screen, you all can see that exit was right at 150. By any chance you did not exit near to the high, that was the point to exit. Now people started thinking that time that the stock is already down so much, let's not sell in extreme loss. And we know till what level the price went down, almost 7.5, 8 rupees. So yes, one needs to follow discipline and one needs to always follow stop losses. The best of the best companies have fallen significantly in the past, and the worst companies have outperformed the market, right? So we need to follow the stop loss and in any position. And remember to follow the strict stop loss when the stock is bound to go either in upper circuit or lower circuit. It has a tendency to go into circuits. In that case, your stop loss has to be keeping in mind the circuit levels also.
Okay, I'll ask that as a bonus question once we're done with the next couple of points. We've reached the eighth point, which you've said, learn to say, I don't understand. I find myself saying this quite a lot, and that helps me read. Is that the truth with technicals and trading as well?
Absolutely, absolutely. So, sometimes when the fundamentals don't justify the moves in the market, people turn up to trading technical guys and say that you look at the chart and tell us what you feel about the counter. And I have most of the times answered saying that I don't understand the present move in the market, and which is absolutely fair to assume and say. I'm sharing one of the charts, and that's of nickel prices. We saw in March, the recent March itself, right, where the counter went up from almost 2,000 levels to 5,500 levels. We saw international markets actually closing the trades for nickel for a couple of days till the time the speculation is taken care of. Now look at this chart. I mean, in a day, if the price goes up from 2,400 to say 3,600, and next day it opens at 4,000 and goes to 5,600, God, I mean, very simple strategy here is to say, I don't understand. If your position is open, you can follow the intraday stop loss and trail the stop loss and exit when there is reversal. In fact, this counter did not give the chance to exit because it entered into lower circuit and came back to 2000 again. So one needs to accept very clearly that there are not always answers available in technicals. Technical is a study which can help us to understand the trend of the market, which is an add-on advantage. We can use technicals for trading, which is an add-on advantage. But every move in market cannot be predicted using even technicals. So one needs to keep that in mind and follow the rule of saying I don't understand when really charts are not speaking about the trend of the market.
Fair enough. The ninth point is, I think, important, particularly for a lot of people that dipped their toes into the market and maybe found that it's not moving the way that they had anticipated. Understand temperament is what you say, and short term trading is not for everybody. Is that something you learn with experience, though?
Absolutely. My hands are always up for this. I have been in market now since 2010 as a full timer. It's been 12 years. I tried different roles. The fear of missing out, making someone seeing someone else making money, and I'm not making money. So I tried my hands on everything. But eventually, I realized that every different types of trading needs temperament. When I recommend something to my clients, so earlier role where I was on the advisory side, I used to recommend the positional trades to my investors, and they were not comfortable because they wanted to make this quick 3%, 5% money. At the same time, the short term trading, when I recommended to few other clients, they told me we are not comfortable watching the market every day. So it's very important to understand the temperament. Short term trading is not the cup of tea of everyone. Believe me, I'm one of them who says that short term trading is not even for me. I developed that skill over the period of time, and now I'm doing 30-40% better in short term trading is a different story. But you need to understand the temperament. You may have other commitments, you may have other roles to play, you may not be able to give that much time. So it's absolutely fine to move ahead in market with the positional trades also if you're comfortable with that, and learn to understand the temperament. If you are into the wrong temperament and you're trying something different, you may not be able to play the game itself. That's very important to understand.
Okay, the last point, you've said to continue learning, but as somebody who has quite a lot of experience in this space, and in conversations we've had on a few other shows, you've pointed out charts that even I have not heard of. What do you read? What would you recommend as literature that people can go to?
So Alex, again, I have been reading almost every day. So, and I have developed that habit in last 5 years itself. Because before that, I felt that whatever the charts were, I was knowing by drawing the trend lines and understanding the patterns and indicators. I think that was sufficient, but that was completely wrong. There are thousands of observations which are made by the other genius personalities in the past. If we read about, say, Jesse Livermore. So he was a guy who made tons and tons of money. He lost everything, and again he made something. We know the entire history of this guy, right? But how the mindset was when he came back again in the market after losing those millions of dollars, how did he approach the market, how he managed his mindset at that point in time, these things are available in books. I'm not just talking about reading the textbooks where we learn how to understand and interpret the indicators, but there are thousands of theories to learn. Technical itself is divided in two parts. One is trend following and the second is predictive. So if you are understanding trend following, try to learn about even predictive theories, which can help us to manage our risk even better. There is no ending to learning as such. There are geniuses available in market who have written fantastic books on the and the material in the market. I think there is never ending story to learn. Keep learning, keep seeing such initiatives which are taken like ET, where you get to listen to many genius people across the market in Indian markets and even foreign markets. I think that's how we evolve over the period of time.
Fantastic. The bonus question which I was referring to is, would you say that initially when people are dabbling or when people are starting out, they should draw a certain boundary for themselves in terms of which companies can I look at trading and which companies should I avoid? Uh, because the reason I'm asking is that people tend to get stuck in circuits on the downside, particularly, and they can't exit. How do they avoid that situation?
Absolutely wonderful. Actually, I should be editing my points and adding this particular point in between itself in future also. So yes, one needs to always stick to those stocks which are large cap stocks in the beginning. Honestly speaking, I follow the same. I don't have any small caps in my portfolio because I'm not comfortable. I'm not comfortable with those 20% up and down. I am comfortable with the stock which is moving 2, 3, 4% by any chance in a week, also in a month, also I'm comfortable because my temperament is not supporting, and risk management becomes very easy when even we are not on the screen. We have seen down circuits and up circuits in markets, and counters have also gone down by 10, 15%. But if my view changes when the counter is down by 15%, I want to book my losses. There should be an alternative available in market to exit the position. If we trade in those small caps and junk category, I would say, where the exit is also difficult because the stock remains in lower circuit, there is no point in even learning fundamentals or technicals. So for the beginners and even for mediocre mid-level people, I would say prefer to trade in F&O counters, futures and option counters, because there is excess liquidity and you get to know the sentiment of everyone by looking at the price action. I think that advice everyone needs to follow.
All right, so we've set the ground rules, hopefully, Kunal. And in fact, by the way, if you're listening to this and you have questions, please do write to us on any one of our social media platforms, and I'll be sure to pass it on to Kunal. Thank you so much, Kunal, for taking the time.
Thanks a lot, Alex.